Underwriting refers to the process that a large financial service provider uses to assess the eligibility of a customer to receive their products. The name derives from the Lloyd's of London insurance market. Financial bankers, who would accept some of the risk on a given venture in exchange for a premium, would literally write their names under the risk information that was written on a Lloyd's slip created for this purpose. Securities underwriting. Securities underwriting refers to the process by which investment banks raise investment capital from investors on behalf of corporations and governments that are issuing securities. The services of an underwriter are typically used during a public offering. This is a way of distributing a newly issued security, such as stocks or bonds, to investors. A syndicate of banks underwrites the transaction, which means they have taken on the risk of distributing the securities. Should they not be able to find enough investors, they will have to hold some securities themselves. Underwriters make their income from the price difference between the price they pay the issuer and what they collect from investors or from broker-dealers who buy portions of the offering. Risk, exclusivity, and reward. Once the underwriting agreement is struck, the underwriter bears the risk of being unable to sell the underlying securities, and the cost of holding them on its books until such time in the future that they may be favorably sold. If the instrument is desirable, the underwriter and the securities issuer may choose to enter into an exclusivity agreement. In exchange for a higher price paid upfront to the issuer, or other favorable terms, the issuer may agree to make the underwriter the exclusive agent for the initial sale of the securities instrument. That is, even though third-party buyers might approach the issuer directly to buy, the issuer agrees to sell exclusively through the underwriter. In summary, the securities issuer gets cash upfront, access to the contacts and sales channels of the underwriter, and is insulated from the market risk of being unable to sell the securities at a good price. The underwriter gets a profit from the markup, plus possibly an exclusive sales agreement. Also, if the securities are priced significantly below market price, the underwriter also curries favor with powerful end customers by granting them an immediate profit, perhaps in a quid pro quo. This practice, which is typically justified as the reward for the underwriter for taking on the market risk, is occasionally criticized as unethical, such as the allegations that Frank Quatron acted improperly in doling out hot IPO stock during the dot-com bubble. Bank underwriting. In banking, underwriting is the detailed credit analysis preceding the granting of a loan, based on credit information furnished by the borrower. Such underwriting falls into several areas. Consumer loan underwriting includes the verification of such items as employment history, salary and financial statements. Publicly available information, such as the borrower's credit history, which is detailed in a credit report. And the lender's evaluation of the borrower's credit needs and ability to pay. Examples include mortgage underwriting. Commercial underwriting consists of the evaluation of financial information provided by small businesses, including analysis of the business balance sheet including tangible net worth, the ratio of debt to worth and available liquidity. Analysis of the income statement typically includes revenue trends, gross margin, profitability, and debt service coverage. Underwriting can also refer to the purchase of corporate bonds, commercial paper, government securities, municipal general obligation bonds by a commercial bank or dealer bank for its own account or for resale to investors. Bank underwriting of corporate securities is carried out through separate holding company affiliates, called securities affiliates or Section 20 affiliates. Insurance underwriting. Insurance underwriters evaluate the risk and exposures of potential clients. They decide how much coverage the client should receive, how much they should pay for it, or whether even to accept the risk and insure them. Underwriting involves measuring risk exposure and determining the premium that needs to be charged to insure that risk. The function of the underwriter is to protect the company's book of business from risks that they feel will make a loss and issue insurance policies at a premium that is commensurate with the exposure presented by a risk. Each insurance company has its own set of underwriting guidelines to help the underwriter determine whether or not the company should accept the risk. The information used to evaluate the risk of an applicant for insurance will depend on the type of coverage involved. For example, in underwriting automobile coverage, An individual's driving record is critical. However, the type of automobile is actually far more critical. As part of the underwriting process for life or health insurance, medical underwriting may be used to examine the applicant's health status. The factors that insurers use to classify risks should be objective, clearly related to the likely cost of providing coverage, practical to administer, consistent with applicable law, and designed to protect the long-term viability of the insurance program. The underwriters may decline the risk or may provide a quotation in which the premiums have been loaded or in which various exclusions have been stipulated, which restrict the circumstances under which a claim would be paid. Depending on the type of insurance product, insurance companies use automated underwriting systems to encode these rules, and reduce the amount of manual work in processing quotations and policy issuance. This is especially the case for certain simpler life or personal lines insurance. Some insurance companies, however, rely on agents to underwrite for them. This arrangement allows an insurer to operate in a market closer to its clients without having to establish a physical presence. Other forms of underwriting: real estate underwriting, in evaluation of a real estate loan, in addition to assessing the borrower, the property itself is scrutinized. Underwriters use the debt service coverage ratio to figure out whether the property is capable of redeeming its own value. Forensic underwriting is the after-the-fact process used by lenders to determine what went wrong with a mortgage. Forensic underwriting refers to a borrower's ability to work out a modification scenario with their current lien holder, not to qualify them for a new loan or a refinance. This is typically done by an underwriter staffed with a team of people who are experienced in every aspect of the real estate field. Sponsorship underwriting. Underwriting may also refer to financial sponsorship of a venture, and is also used as a term within public broadcasting to describe funding given by a company or organization for the operations of the service, in exchange for a mention of their product or service within the station's programming. Thomson Financial League Tables. Underwriting activity reported in Thomson Financial League Tables, numbers in dollar billion, global debt, equity and equity-related. See also, initial public offering, investment bank, predictive analytics, Thomson Financial League Tables, medical underwriting, underwriting contract, guidewire, references. External links, underwriting explained on Investopedia.